All right, so we're into our Infinite Banking for Beginners series. Even though some of these concepts aren't necessarily truly beginner, but they are part of the beginning stages of understanding the infinite banking concept. That being said, we're going to talk today about policy loans. Some might call them the eighth wonder of the world, perhaps. At least in the financial world, I would argue that they probably are. But we can talk more about that specifically here in just a second. So, first and foremost, let's talk about what a policy loan is. So, as we've talked about so far in the series, you're using a dividend paying whole life insurance contract as the basis of capitalization for your infinite banking system. And as a result of that, you're going to build up cash value in the contract by design within the policy itself. The cash value naturally has to grow to reach at age 121. It has to reach the death benefit. So as the policy is growing, paid up additions, guaranteed growth, et cetera, that cash value is always growing to reach that death benefit amount, even if that death benefit amount is ever growing over the course of that time frame. So what we're doing with a policy loan is it's really a loan from the insurance company contractually that you have the option to do, and you're collateralizing against the cash value in the contract. So you are really taking a loan against that cash value that's within the contract, and it's being paid back to the insurance company. Now, again, this is all by design, by the rights that you have within the contract. As a contract owner, you have this capability to do that. Now, depending upon the company, you're going to have a loan amount that you can loan up to in a given contract year. How much of that you're able to access depends upon how much cash values in the contract at that time. In the last video, we talked a little bit about policy design and policy structure. So you could have, access to, say, maybe 70% of the total premium that you paid within the first year, perhaps. Just using that as a brief example. Not saying that that's the ideal design. It's just simply an example. So that being said, you'd take a loan against that, and then you're free to use that once that money comes to you, either in the form of a check or in a electronic transfer of funds directly to your bank account. You can set it up any number of ways, but you can request a loan. There are no questions asked when you request that loan. I would say that's probably one of the biggest things that just blows people's minds when they follow and start doing this process, is just how easy it is to take that first policy loan. You simply log into your account, or in some cases you have to fill out a form. We submit that to the insurance company, and they send those funds typically within 3 business days if it's electronic funds transfer, or a lot of times within 5 to 7 business days via check. From there, you can do it with it whatever you want. Maybe it's to invest in a business that you're wanting to start, or perhaps it's some other sort of cash flowing asset, or maybe it's something simple. Maybe it's because you want to buy a new vehicle, or you are, there's a roof that you have to put on your home, like I did. These are things that you can use that cash value for, and then once you do that, really the repayment is up to you. How you want to repay it is totally up to you. And again, this is something that kind of blows people's minds about how this works. There is no dedicated repayment structure. How you repay it is your decision. Now, I highly recommend that you put together some sort of structured repayment plan, because it's important to be an honest banker, like Nelson tells us in Becoming Your Own Banker. That's a critical, important part of the infinite banking concept, part of this process. So you are able to then set up some sort of repayment structure. Now, I want to take a step back here and talk about the term loan for a minute. Yes, it is a loan against the cash value within the contract. However, this is not a loan in the typical sense. Remember what it's a loan against. It's against an asset you own and control. So when you are making a policy loan repayment, you are not simply just having that money leave your hands forever and going right to a bank, going to a third party institution, etc. It's actually replenishing the capital in your system. So it immediately goes to principal and knocks down the size of that existing loan. So let's say, for example, you have a $10,000 loan and you make $200 payments every month over the course of the next 12 months. At the end of that 1 year, over the course that you took that loan, your balance would be reduced by $2,400. So you would have about $7,600 on that loan. Now, again, the great part about the way that policy loans work is how the interest is tabulated. It's done on a daily balance perspective, but it's very simplified in that whatever the balance is on that loan on that day, that kind of gets tabulated on the side by the insurance company, and the interest only hits or only gets applied to your account at the end of a policy year. So it's not necessarily accumulating and growing, and the interest isn't constantly compounding on from that perspective. And I have a good example that I'll show you in just a minute for my own personal policies that we have used this concept for, to show you just how powerful this can be. But again, just kind of laying out the basics of how it works. Now, let's say, for example, maybe your repayment system or your repayment plan relies on, an upcoming windfall that you are expecting. So maybe you get a bonus every year and you want to just have that go and repay your $10,000 policy loan. Well, you can do that. You can just leave it sit, don't make any repayments over the course of that year, and then pay it all at once. Or, maybe your income cycle is just different and you get paid quarterly for some reason, within a business. Sometimes that happens. Your cash flow cycles, you get paid every quarter, or that's kind of how the cash flow comes in. You don't have to make those payments. You can simply wait until you have the capital come in, and you can make that capital repayment or that replenishment to the system by repaying that policy loan. Again, one great exciting thing about this process is usually within anywhere between 5 and 10 business days, depending upon how fast the company works, that money becomes immediately available to you again. So you can take another policy loan if you need to. Why is that important? Well, that allows you to cycle significant amounts of capital through the system over the course of a year. So if your capital needs require $30,000 over the course of a year, as a rough example, but you only have $10,000 of available cash value the first year, well, as long as you have the cash flow, you can simply cycle through that $30,000 by cycling the $10,000 3 times. That's very possible, very plausible to do in those situations. So just a rough example. Now, a couple of things that I want to talk about before I jump into my specific example from our system. There's a lot of misconceptions about policy loans. Some of them, and probably the biggest stigma, is that people treat it like a standard loan instead of a capital replenishment. And again, that comes back to just rethinking your thinking. If you're thinking like a banker, you will be seeing your policy loans as future assets, meaning that that's an asset to me because when I make the repayment, that capital comes back to me. And if I'm being an honest banker and I'm charging myself an appropriate rate of interest, at least at the market rate, that extra interest that I would have normally paid to a bank is actually going to benefit me by going back into the system as paid up additions, expanding the system further, et cetera, et cetera. That's a whole topic in and of itself, but it's important to understand that you are the banker, so that when you have these loans out and you're making those repayments, that's an asset, that's money flowing back into your system, into your hands. So you should not be thinking about it as a loan where, well, now I have a payment and that money's going to be gone forever. It doesn't work that way. That this is part of the process of becoming your own banker, is starting to see things differently and allocating that capital appropriately so that you're able to recapture a lot of that money that would normally leave your hands over the course of the year by financing things. Remember, everything is financed. So let's talk about something more specific. So my family, one of our policies we use for a number of different things. Our homeowners insurance, we use it for our annual car insurance, our taxes, a number of different things. So we have a lot of money that's flowing through in and out of our hands over the course of a year. But there's only so much available. So in this particular case, we're going to be looking at one of our policies. Let me show you a couple of things. So in this particular situation, we had $5,354.99 going into our policy year on 5/24/25. So in that year, that's what we carried over as a balance at that time. Over the course of the entire year, we actually took loans of $41,309 over the course of that year. So that's a pretty significant amount of capital flowing through the system. I actually think we might have had about $20,000, $24,000 in available cash value in that year. So I apologize for that. That being said, the loans repaid, including interest. So we were being honest bankers over the course of the year. And this interest amount does include this here as well, but there was $32,083.32. Now, one of the things that you'll see here is that there was an interest rate over the course of that year, which was 7%. Now, some people might say, like, well, why would you take a loan at 7% when you could have theoretically got a quote unquote lower rate somewhere else? Well, this is why it's important to think like a banker. I want to be the one who's in control. I also need to go back to reference you back to the volume versus rate conversation. And we're going to look at that in just a second about the volume of interest that was actually paid on those loans over the course of the year. So the volume is critically important. And that's what I was getting at earlier when I was talking about how repayments go, and meaning that they go directly to principal first. That impacts the volume of interest that gets paid over the course of a year. So let's flip back here. So anyway, 7% was the rate. The interest amount that we paid over the course of that year was $1,097.72. Again, that's against loans of $41,309 over the course of that year. Now, we ended the year at 5/24/26 at $15,678.39. So we did carry over a higher balance over the course of the year at the $15,678. But again, we did make a substantial amount of repayments. Now, in a traditional financing sense, if I needed $41,309 in capital access, I would have to pay interest on that entire amount. And if we think about what that would be if it was 7% in a traditional loan scenario, well, that would be about $2,800 in interest. Well, you can see that I actually paid $1,097.72. Now, could you theoretically get there through a traditional loan? Maybe. And I say maybe because does that bank or does that financial institution allow for principal reductions on the type of loan you would take? And in most cases, they're going to get their interest no matter what. So chances are probably not. But what you'll see in what we see in this particular situation, just kind of going back, is our total cost of capital over the course of that 12-month period was $1,097.72. And if we divide that out by volume against that $41,000, we come to a net cost of capital of about 2.66%. So that's why I like to look at policy loans as that eighth wonder of the world, in that they truly are amazing in what they allow you to do. Now, does that mean that's all I'm going to ever put back into this system is just the premium plus the actual interest I paid? Absolutely not. I wouldn't be an honest banker if I did. So that being said, as I've made these repayments, I'm thinking about, yes, I'm saving by using the system, by paying less interest, but what am I doing with what I had recaptured? Well, over time, that's going to go back into the policy as paid up additional premium to, again, further expand the system, be an honest banker, and continue to capitalize. So that's kind of a realistic scenario, at least in my example, of what this looks like. And it's pretty impressive the way that it actually works out in practice, in that you're able to access a significant amount of capital, you get favorable repayment terms, You replenish your system and you're able to go do it and use it again and again and again to finance all the things you normally would over the course of your lifetime. So just in wrapping up today, we can see just how powerful policy loans can be in a financing system for your family, for your business, whatever it might be. They are extremely flexible. They have a lot of guarantees that allow you to be able to access them in the first place. You have very favorable repayment terms. And again, you're replenishing your own capital as you make those repayments. So it's a really beneficial system all the way around. And if I do have to pay interest, it's going to a company that I'm part owner of because it's a mutual insurance company, meaning I'm part owner. So that interest that I do end up paying actually helps contribute to the profitability of the company and in turn benefits the dividend structure within the policy. That's more in the weeds, but it's a separate conversation. But in general, it's a beneficial situation all the way around for myself, my family, the insurance company, etc. And it's just a great net benefit overall of using a system like this. As we transition out of this video and into the next one, we're going to be taking a closer look at some of the biggest misconceptions that exist about the infinite banking concept. And while I have other videos on this that I highly recommend people to take a look at, that will be the next video that you'll see come up here. And I hope that you enjoy it. I hope you learned something today, and we'll talk to you again soon.